Okay, good morning, everyone. We're from Group 11. We're going to present our presentation about using SAVANT framework to guide tax planning. But before that, we're going to introduce ourselves with a group member. First, Muhammad Alfarrabie and me, Gina Harun. Okay, to begin our presentation, I want to explain before about SAVANT framework. In strategic tax management, when a firm chooses transaction, it keeping tax management in mind. The transaction approach, the SAVANT framework is like we see in here in Exhibits 2.1, that there are four component strategy: anticipation, negotiating, and transforming lead to the value adding. Okay, the firms look to engage in transactions that maximize and offer value. It can choose from a constellation of entities transaction, and the choice then is put through the lens of the firm's strategic objectives. The firm anticipates its future tax status and chooses the timing this year or a future year of the transaction. Anticipation in this means if there's a tax advantage to adjusting the timing of transaction, the firm should do so, provided the non-tax economic still makes sense. And the taxes are also negotiated between the firm and the other entity. Does negotiating mean the firm seeks to shift more the tax burden away from itself, and by negotiating the terms of the transaction? After taxes is value added to the firm, like taxes value added often incurs to the firm over time, because it's a fundamental principle that cash inflows are more valuable now than later. Then tax management takes into account the time value of a transaction as well. Okay, to begin the discussion of our presentation, there are 6 topics to discuss. The first 3 topics will be presented by me, and the last 3 topic will be presented by Abi. Okay, the first one is strategy. Tax management should work to enhance the firm's strategy and should not cause the firm to engage in tax minimizing transactions that deter it from strategic plan. The resulting strategy derived from the first objective, appraisal, is often referred to as WOT, matching internal strengths and weakness to external opportunities and threats. A strategic management imperative result from this analysis. Strategy provides a vision where the firm wants to go, typically represented by the mission statement. In its competitive analysis, the firm needs to understand whether it has tax advantage or disadvantage in relation to its rivals. Corporate strategy focuses on the first station of the business, and then the next strategy is international strategy. It focuses on taking advantage of corporate and business strength in global market. And the question about the strategy: how does effective tax management interact with strategy? First, a firm should not alter the form of a transaction in order to manage taxes if the change is inconsistent with its strategy. And the second one is a firm competitive strategy may be shaped in part by its tax status. And we can see the example of the strategy, like suppose the US government announced 20% income tax deduction for purchasing new equipment. Both of firm is the biggest competitor are thinking of acquiring new equipment. The firm is 35% tax bracket. The competitor will be an NOL situation for several years. Example, it is 0% tax bracket. If the new equipment costs $1 million, the firm after tax costs it less than this because it enjoys the tax deduction related to purchasing the equipment. The benefit of the new deduction, for example, is 20% of the $1 million cost times the 35 tax rates, or $70,000. Even ignoring the other deduction, like depreciation, the firm after tax cost the new equipment is only $930,000, whereas the competitor after tax cost is $1 million. The firm can use this cost advantage to buy more equipment, cut prices, and undercut the competitor or invest in the new projects. Okay, the next topic is about anticipation. Anticipation in certain tax change. Suppose it's known that the tax rates will rise substantially next January. If it's now December, the tax rate can be anticipated, assuming it's not the otherwise harmful. Simply that the lying December expense until January means they have more bang for the buck that month by the deducted the higher taxes. And the next is effects of the net operating losses. If the firm generates an oil the current year and the loss can be carried back and used in its entirely in the previous years, the NOL should have only a minor influence on how the firms adjust the timing of its current income deductions. However, timing can be very important if the NOL is not used up in the offsetting prior years' income, but is expected instead to carry forward a number of years. And the next is the anticipation and the uncertain tax changes. The tax management firm can anticipate tax changes before they become official. Employing this anticipation strategy entails assigning a probability to the likelihood of the tax legislation being enacted. Then is anticipation and price effects. Firms should attempt to anticipate price effects resulting from tax changes. This include the elasticities of the supply and demand and whether additional suppliers can enter the market. If there is a tax increase in some goods, service, or investment, the opposite effect, of course, like a price drop. And the third topic is value adding. Ultimately, most measures of the value adding are derived from the firm's financial statements. Related to the accounting's earnings are the firm cash flows. If the net present value of cash flows from a transaction is positive, then over time, this will translate into positive financial earnings. Both typically enhance shareholder value and increase management compensation. Using the cash to measure value adding. To understand this topic, we have some examples. Suppose a firm buys some unimproved land in 1 year as an investment for $1,000 million. At the end of year 2, it sells the land over $2.5 million. The firm's net income before the land transaction and before management bonuses for years 1 and 2 is $10 million and $11 million, respectively. There are 1 million shares of the common outstanding. Management received bonus of 5% of pre-tax income. The firm is in the 35% bracket. The value adding effects from the land transaction are like we see on the picture. And this cash inflows, this from the examples, we can measure that cash flows will rarely exactly equal to the sum of financial earnings change over time. Therefore, discounted cash flow DCF analysis is critical in measuring whether the tax management method will increase the firm value. Then, the holding tax rates and basis constant tax management implies the fair income and accelerated deduction. More formally, it is net present value NPV of the expected taxes that managers should work to minimize. Like we see on the example, a firm can make 1 or 2 investments, both have 3-year horizon and both have identical pre-tax cash flows of $100 per year. The taxes for the first investment are $60 in total, that is $20 in each of the 3 years. The taxes for the second investment are also $60, but the tax is all due in the 3rd year. If the firm has the 10% cost of capital, then the present value of tax taxes under the first investment is $20 multiplied by 0.9091 plus $20 multiplied by 0.8264 plus $20 multiplied with 0.7513, and the result is $49.74. The present value factor for year 1 is 1 divided by 1 plus R multiplied by N, and that the result is then 0.9091. That for the year 2, like we see on the example, like 0.8264. And for second investment, the tax is $60 and multiplied by 0.7513, and its result is $45.08. Thus, simply through the time value of different the tax, the second investment has higher value adding to the company. Next topic is using other measure value adding. Popular annual financial statement measure the earning per share EPS, return on equity ROE, net income divided by the shareholders' equity, and economic value added EVA. EVA has become increasingly popular. It computes as after-tax operating profit minus the firm's weighted average cost of capital. EVA can be decreased by the lower after-tax operating profits, using more capital or using more expensive capital. It is important to note that exclusive use of EVA or ROE is not recommended for evaluating long-term projects. And next topic about the maximizing value adding and potential conflicts. Maintaining or improving value adding is implicitly a contract between the manager and the firm shareholders, closely related to explicit contract based on the financial accounting information. So how should one measure the value added of tax-related transaction to shareholders? We can use NPV, but also consider any important financial statement measures and financial statement linked contractual issues. And then this about one on taxes, value adding and book tax difference. If a firm never expects to pay the tax on someone's income, then for financial reporting purpose, it will not show a tax expense. Such a permanent difference are the best all worse. Neither the firm's cash flow nor the financial earnings are reduced, and more common than such permanent difference that are those that are temporary. And this occur when the only difference in actual taxes paid and the related taxes spent on the financial statement is period in which they occur. In the future years, book depreciation will be higher than that for tax purpose, and that is the timing difference will refers. This is about adjusting value adding for the risk. A risk premium is a discount on the purchase price that manager will have to be offered to accept a risky project. The risk premium aspect is important for two reasons. First, many tax-favored investments have a special tax status because government is trying to encourage investment in relatively risky investment. Second, the tax benefit may be the equivalent of risk premium. Risk from possible tax law change must be managed as well. This concept is directly related to anticipation of tax law change. We can see for the example is suppose the manager anticipates that here is a 50% probability that tax rate will decrease by 10%, the variance of the expected return will thus be reduced by 5% for both gain and loss. Then next topic is value adding and transaction costs. Tax management requires that the tax savings exceed the related execution cost in any transaction. Transaction costs might include broker's fees or legal accounting costs. Some examples of transaction costs are first, stock broker fees on the sale of stock, next, attorney accountant and investment banker charge on mergers, acquisition, and recapitalization. And next is lobbying costs to obtain favorable tax structures prior to locating the new plant. And the last is temporary loss of funds when paying an expense in December instead of January. Next topic will be presented by Abi.
Okay, thank you, Gina. Well, for the next topic is about negotiating. An effective tax planning involves negotiating tax benefits, both with tax authorities and with other entities involved with the firm in a taxable transaction. Negotiation with a non-governmental party to a transaction is a function of the relative tax status of the parties. That is, the benefits or cost can be shifted between the parties by negotiating the purchase price. Well, for example, we suppose a firm is selling an office building with a market value of $2 million, of which tax benefits or through depreciation are worth for $300,000. If the selling entity is in a non-tax paying situation, for example, using the SAVANT framework to guide tax planning 83 non-profit organization that is exempt from US income tax, the tax benefits are worth nothing, literally nothing. So the firm should be willing to sell for less than $2 million. And then a taxable purchaser should be willing to pay up to $2 million. Next, please. Okay. The government can be negotiated with all levels. The tax jurisdiction may give special tax breaks to new businesses to locate in their jurisdiction. The amount of the tax break is a matter of negotiation between the government and the manager of the firm. At all government level, one last negotiation level exists, that is the audit level. If the firm's tax return is audited, agents and their supervisor often negotiate the settlement of taxes on. Well, you can see in the picture shows the opportunities for shifting taxes to other parties. In this situation, is the firm shifting the taxes to suppliers or customers or even the workers. The next topic is transforming. Well, the tax management also includes transforming certain types of income into gains, certain types of expenses into losses, and certain types of taxable income into non-taxable income. Regarding the latter, losses on sales of capital assets such as raw land or financial instruments are deductible only to the extent that the firm has capital gains. Thus, the firm would like to transform the capital losses onto ordinary losses. Well, in general, tax management seeks this transformation, such as the taxable income or gain onto the tax-exempt income or gain, the ordinary income onto capital gain income, the non-deductible loss or expense into deductible loss or expense, and the capital loss into ordinary loss. One significant example of gain transformation is the sale of stock. If the corporation sells appreciated assets and then distribute the proceeds to shareholder, the corporation pays taxes on the gain, and the shareholder will ordinary income on the dividend. Instead, if the corporation liquidates, the appreciation is taxed to the corporation, but the subsequent distribution to the shareholders likely is taxed to them as capital gains. This transformation method can save the shareholder a significant amount of taxes. Well, the next topic is the SAVANT concept. We illustrate the SAVANT concept. Well, let's study a case. For example, as the CFO of a computer manufacturing company, it has come to our attention that a computer chip manufacturer is for sale for $10 million. It is privately held by the 5 engineers who start the company. The value of the net underlying assets is 9 million, with 1 million of value attributed to its highly successful R&D department. The reason the company came to our attention is because each year it throws out about 1 million in tax benefit through rapid tax depreciation of equipment and tax credit for its R&D. The tax benefits are very attractive, but we ask this question to determine whether the acquisition makes sense from a strategic tax management perspective. Well, does the acquisition fit with the firm's strategic plan? On further inquiry, we determined that the company's chips could be used in the manufacture of our company's computer. The acquisition could assure quality by using the SAVANT framework to guide tax planning 87 control of a chip manufacturer. In that sense, it would give us a strategic advantage over our competitor. Then, what is the anticipated effect of the sale? Well, our major competitor has a net tax loss, so it may not make a play for the chip manufacturer, or it may make a lower bid. We anticipate that the tax benefit will continue, with R&D tax credit actually increase due to a more liberal tax policy that will go into effect for the next year. Well, the next question is, will there be an increase in value added? Then the acquisition would be financed with 8% debt. After the tax deductible interest expense, the cost of this capital is 8% multiplied by 1 minus 34% multiplied by $10 million. And it is the result is $528,000. After tax operating profit for the acquisition is $800,000 per year. Thus, value added is $800,000 minus $528,000. It is equals to $272,000. This is also the net increase in financial accounting earnings and the annual cash flow. Well, what transaction cost would be involved? We ascertain that the $400,000 of legal, accounting, and loan fee cost will be incurred. Half of them are the tax deductible. So the after-tax cost is $400,000 minus 0.34 multiplied by half multiplied by $400,000. It is equals to $332,000. We know that this is the $60,000 in excess of the first year value added. However, assuming that we hold the company for 10 years, there is still a positive net present value of $60,000 for the year 1, plus $4,625,360 for the sum of years 2 through the years 10, or it is equals to $4,565,360 The latter figure uses an 800% cost of capital for 10 years of annuity with a resulting factor of 6.7101 less 0.9259, or it's for the year one factor, or it is 5.7842 multiplied by $800,000 per year. Well, should there be an adjustment for the risk, we assign a necessary 10% of the risk premium because chip manufacturing is subject to intense competition. Well, the next question is, can any income or gain or deduction or loss be transformed? The answer is, if the acquisition turns out to be bad, it can be sold or part of it spun off to a separate business in a transaction qualifying or for capital gain treatment. Alternatively, regarding negotiation, we can give the target company's shareholders stock in our firm in exchange for their stock, which would qualify as a tax-deferred transaction for them. This might result in a lower purchase price. Therefore, based on SAVANT analysis, we decide to acquire the chip manufacturing company. Well, there is a few pictures that we have to mention in the 7 concept illustrated. That is the tax management, the involvement in transaction, and the scanning the changing tax environment. The tax management. The effective tax management means that employing the 7 principles to every important transaction. It also means periodically scanning the environment to see what has changed that would require the new tax management strategies. And then the next is involvement in transaction. Well, all too often, important business transactions are structured without considering taxes. Subsequently, the tax specialists are brought to see how taxes can be saved for it all, given the already agreed on form of the transaction. Instead, managers should consider taxes simultaneously with all other costs. And the last is scanning the changing the tax environment. If the word around the firm never changed, the management of each transaction would be enough. However, the environment does change, of course, and a manager's due diligence is to scan the environment to see what changes affect the firm and how the firm should react. I think that's all from our presentation. I will be given back to Gina.
Okay, thank you, Abi. That's all by the end of Abi's presentation. That's the end of our presentation as the group 11 on the 7 framework presentation. Thanks for the attention. See you.